This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the proud papa. It is Robb Reinhold.
Well, hello everybody. And yes, Patrick, I'm definitely a proud papa here. But I got to say, most babies, they take about 9 months, 9.5 months to come. This one I've been working on for 11.5 months. So this is like elephant style baby coming out.
I'm telling you, we're really looking forward to getting into this episode, and you'll see why in just a moment. But let me go ahead and remind everybody, because we try to do this at the top of the show, I normally forget, that this episode and every episode is sponsored by Maverick Trading. There is a stocks and options division, and there is also a Forex and crypto division. You can join either one. It is the best prop firm in the world. I've been there 10 years myself, I can tell you this. And you are about to see just what can be accomplished at a firm such as this. So Rob, tell everybody, because I don't know when people have joined. Some people have been with us the whole time. Some people have only been with us recently. Some people might be coming here for the very first time ever. What exactly, not what it does, but what is flat earth trading?
Well, in August 1st of 2023, I started the Flat Earth Trading Society YouTube channel. Now, the reason I decided to call it Flat Earth Trading Society, because I wanted to expose the conspiracy of trading. And what that conspiracy is that everything you read about is all about the entry. Any book you pick up, any website you go to, everyone's always talking about getting in at the right time, getting in at the right time, getting in at the right time. And I wanted to point out that the biggest conspiracy of trading is that the exit is more important. The exit is more important than the entry, but yet everyone puts all of the emphasis on the entry. Patrick, one of the things we've been doing in this Trading Psychology podcast is talk about all of the problems that come into your trading after the entry. Very few of the problems happen before the entry. They all happen during the trade or because of what happened in the last 5 trades. So this experiment was to do exactly this. We decided we were going to do 100 trades, and we were going to do them randomly on our YouTube channel, and to show that we could make a profit choosing random stocks, random currencies, random metals, whatever it is we traded using position management.
Yeah, I've been telling people this for years, but nobody ever wants to hear it. The videos that always rank the highest on YouTube when it comes to any kind of trading is technical analysis and getting in at the most optimal time. And I told everybody, that is not when you make your money. You make literally all of your money on the exit. Yet this is the part that nobody ever pays attention to. So you spoke about randomness, and I think that's kind of where the whole idea of flat earth trading comes in. So can you talk about the method you actually used to pick some of these positions?
We did 100 trades. I know some of the notable ones that I liked was a Ouija board. I used a Ouija board, I think 3 times. So I had to go first invest in a Ouija board. I don't think anyone's ever used that term, invest in a Ouija board, but that's what I did. I used Scrabble tiles. I love to travel, so I do a lot of traveling. So a lot of the trades were based on my travels. I was over in Europe, and so we used European stocks. We use train stocks when I take trains places. Just lots of things like going on either in my life, or on Fridays we always did like a trade on the news. We pick something that was in the news that week and make a trade based on that. And we usually used a lot of like a random wheel. We used quite a bit online where we had 10 stocks and we just spun a wheel, and whatever one it landed on, that was the trade we made.
So completely random. No rhyme or reason why you even chose the instrument you chose. So that was something too. Okay, cool. So now I would imagine that with just any basic, sensible position sizing and exit strategy, that this should go fairly well if you just stick with it. So before we get to that, can you just tell people who are playing at home here what exactly the exit strategy was and the position sizing and everything like that, just so everybody can kind of be up to speed here?
The exit strategy was very simple, and it was completely automated. We were going to do a 1% risk on the trade, meaning we would do our position sizing. Based on if we were stopped out, we would experience a 1% loss in the account. Then we simply put in a trailing stop on the entry, and that trailing stop was in place the entire time. So if the stock ever went against us, more than 2x ATR, it got us out. That was just the basic rule of the trailing stop. And then if we got a profit, we would snug up that trailing stop a little bit over time. But really, the whole idea of this was you're going to get over 100 trades, no matter how hard you try. You will get a bell curve distribution of results. No matter how good you are at charting, no matter how good you are at calling the markets, you're going to have the tails. You're going to have 4 or 5 amazing trades out of 100, and you're going to have 4 or 5 complete garbage disaster trades. No matter how good you are, no matter how hard you try, you will have 4 or 5 garbage trades. The whole premise of this experience was, hey, how about we chop off all the garbage trades at a 2x ATR loss, but yet let's leave all the great trades to go 5x, 6x, 8x ATR to where we can get an asymmetric return. And that's why I was so convinced that this was going to happen, because I knew that when you get that bell curve distribution, if you just chop off that really nasty left side of bad losses, the numbers will work out for you in the end.
So I'm sure there's a lot of people who have been listening to us the whole time, especially newer traders who are like, okay, this all sounds great in theory, makes total sense, but does it actually work in practice? And so this is exactly what Flat Earth Trading was trying to accomplish. Now you have just approached your 100th trade. You now have a full 100 trade sample size, which I feel is probably enough to get a pretty reasonable idea of if this very simple yet disciplined theory works. So go ahead. Let us know, Rob, what were the actual results after 100 random ass trades with nothing more than a basic, simple position sizing and money management strategy that you just simply stuck to?
Let's just start off with the one everyone wants to focus on. What was the return? Well, we started with the $100,000 account, and at the end of that 1 year period, that account was at $114,674. Now that is after fees. When you just take a look at the trades themselves, the account was up $15,000.26. So that was a 15% return. And during that period of time, we never really had more than 20 to 30% of the account invested at any one time. So there was a lot of cash left sitting there that could have been doing a lot more. But look, that wasn't the purpose of this experiment. And actually on about trade 95, I got a comment saying, hey, you're up nicely, but you didn't beat the S&P. This trading strategy is garbage. And I responded, okay, you obviously don't understand the purpose of this. The purpose of this is not to actually use this system to trade, because guess what? This system is not the best system that you can design or that I can design. It's a very simple system made for this experiment. There are much better ways to design this system, so no one should trade it. The purpose of this whole thing was just to show you consistency, and following a position management strategy that makes sense will yield positive results.
And let me go ahead and add, too, a couple things that are fairly obvious. One, almost every other year, this strategy does beat the S&P 500. And this, when you do things like this and you get to trade long and short, then this is pretty much how it's going to be almost every time. Two, this is a very, very conservative position sizing. I get made fun of for being too conservative when I tell people to go 2%. You went 1%. So you can almost reasonably assume that if you went 2, this would be almost doubled, minus fees and drawdown and things like that. So everybody just kind of keep that in mind as Rob moves forward.
Let's keep going with the numbers. So the win-loss percentage ended up being exactly 40%. So we had 40 winners out of 100. So that was the win-loss percentage. Now look, I already knew that it was going to be around 40%. And if you go back to the very, very first video I did, I said that we are setting this system up knowing that when you put a stop in at 2x ATR, you have an X percentage chance of being stopped out, and it was right around 33, 34%. I already knew that, look, we were going to have, 34, 40% of winners, but then we were going to have a whole bunch of stuff in the middle that went up a little bit and then pulled back 2x ATR. In my mind, I thought, hey, we're going to be around 40%. For most of the experiment, we were actually down around the 33, 34% range. And I was like, hey, this is a little bit lower than I thought. But by the end of the experiment, we were right up to the 40% win-loss.
Well, I have to jump in here. If you're pretty much coin flipping this entire time, how did you expect to end up at 40% and not 50%?
If it was a true coin flip, we would be using basically a stop and a limit order. The fact that we didn't have a limit order up at 2x ATR, so if you put in a stop at 2x ATR and then a limit at 2x ATR, you would have expectations of 50%. That's just what you should have. The fact that we had a trailing stop, so just think if a stock went up $1 and then pulled back, then all of a sudden that's going to be a loss. So we knew that 32, 33% of the trades were going to hit that initial 2x ATR loss. We knew that. What we didn't know is how many were just going to be oscillating in the middle, where they went up $600 and then they pulled back and created a $400 loss. That was where we didn't know. We knew that we were going to have, 32% that went up above 2x ATR and kept going. What we didn't know is how many in the middle would, go up a little bit and then pull back and knock it out. So I just estimated.
Okay, fair enough. And there will be a more detailed analysis of this. We'll talk about that more towards the end, but we're just going to stick to the main stats right now. I just want everybody to understand the results you're about to hear, start to back, or all the other results you're about to hear, came from a system that only won 40% of the time and had, I'm going to say it again, had a 1% position sizing instead of a 2. So just factor all that in as you're listening to this, and just think what actually could be if you were to get those numbers up a little higher on the percentage side.
And remember, this is doing dumb stuff like Ouija boards, Scrabble tiles, coin flips. Like, you can do better than a Ouija board. At least I hope you can. Let's follow up with the numbers here. If you go back to my very first video, I said, we are not going to win this by win-loss. We're going to win this by profit factor, meaning I know that out of 100 trades, I'm going to get 3 or 4 really big winners. I know that. And if I can cut out the 3 or 4 really bad losers, I already know I'm going to have a profit. So the profit factor was 1.38. So basically, if you total up all the gains and then divide it by all the losses, that's profit factor. The average risk reward, winners were 1.9 to 1. So 40 of the trades won $1.9 for every dollar that the 60% lost. That is how it made money. The average winner was $1,351. The average loser was $662. That's right there. That's how you win this game, is right there. Think about it. Your average winner, $1,300. The average loser, $600. You don't need to be much more than 40% to have a really nice return. If you can bump that up to a 50% just on some basic learning how to read a chart and having better entry points, better than a Ouija board, that's a really good trading strategy.
Yeah, I mean, it's really simple, guys. It goes back to the very basics. Cut your losses and let your winners run. Don't cap your upside. And if you just do simple things like that, this is what comes out of it, even with a 40% win rate. So, okay, so we have a lot more numbers here to go over, Rob. And what's really interesting about this is every set of numbers really corresponds to an episode we've done here on the podcast. So, Rob, I'll let you put the numbers out and give a little explanation on them, and I'll jump in and say kind of where this correlates to which episode we've already shot.
When we were talking earlier, that's exactly what we said, is that so this is a real world trading experience with real capital in a real market. And we've always said you have no control over the return. All you have control over is your system and not screwing it up. And so throughout the year, we had runs, we had falls, we had drawdowns, we had wild successes. We had all those things. And in every single one of those situations, we've talked about that in one of the episodes where a real live trader in that real life situation would have a psychological struggle come into their trading that would try to get them to deviate from following their system. Now, we've talked about how you have no control over the market. During this period of time, the S&P had a pretty good return. So it was from August 1st, 2023, all the way to, I think our last trade closed out on like July 15th, maybe July 20th, somewhere around there. So almost a full year. I don't have the return of the S&P during that time. I think it's probably close to about 22, 23%, but I don't have that number. I'll get that number later. But during that period of time, if you were to break out all the longs versus the shorts, the longs were profitable almost $19,000, $18,919. The longs were profitable, and all of our short trades were actually a drag. They were down $3,919. So we were making short trades during that time. And the whole time, the market was mostly going up. Those are going to be a drag. Now, of course, you look at those numbers and say, well, why don't you just go long all the time? Well, guess what? In a market like 2022, it probably would have been the exact opposite. This is where being a trader, you need to be market agnostic. Whether it's up, down, or sideways, your strategy should work in all market conditions.
And I guess this kind of goes into the episode we talked about when it comes to biases, how everybody has an idea in their head already whether a particular currency pair or a particular stock or indice or crypto pair should be going up or down, and how that might actually throw a wrench into our plans when our actual system is telling us to go the opposite way. And so I guess the real takeaway here is to do what we said in that episode and just completely ignore it. Everybody has biases. It doesn't mean you're right. Your system has been proven to be right through backtesting. You have not. So always default to your system in these particular situations.
The beautiful thing is that with a good system should be putting way more long trades on in a bullish market than short trades. That's how a system should be designed. And it should be putting on more short positions in a down market than an up market. I mean, that's just how a system should work. All right, now next I want to jump into some of kind of the highlights, some of the big highlights, some of the big wild successes, and some of the spectacular failures. So I want to first talk about the largest win of the experiment. The largest win was a stock PIO. Now, I put this trade on when I was traveling in New Zealand. And for any of you who have ever been to New Zealand, it is an absolutely stunning country. It is outdoor paradise. There are waterfalls and water everywhere. I mean, every single turn is the most amazing thing you've ever seen. And so I was so impressed with the water, I said, hey, let's do a trade on water. And I looked up that there's some water ETFs, stocks that own other water companies. And we ended up buying this PIO, and it ended up going up, 6.6 ATR is the biggest gain we had. So we had 6.6 plus ATR on this one. It was the biggest gain. Now, what did we learn from this gain? Now, look, we knew we were going to get one of these big ones. What did we learn? Well, I did this because, I was on vacation. I hadn't put out a trade in like a week or two. I'm like, hey, I need to make a trade. I made a quick trade on this PIO. And then you know what? I went back to vacation. I gave this trade zero thoughts whatsoever. It ended up being the best one.
Well, it seems like you did give it a little bit of thought because the theme was water. I don't know. I guess it's still pretty random. But I'm just trying to think of what like a total hater who came into your YouTube channel would say, because haters will find any little wrinkle, any little angle they possibly can to try and discredit your theory.
But look, I could have been short. I could have been short PIO. I could have been long PIO. Like, it could have been anything. But the point for this trade is, just think about how in trading, how hard we all try to make great trades. We try so hard. and we spend so much mental energy and we spend so much stress and put so much pressure on ourselves when really you have no control. You have no idea which one of the trades that you make are going to be good and which ones are going to be bad. You have no idea. One of the very first things we have people at Maverick do is go through my talk. I call it the 10 trade analogy, where in the next 10 trades you make, you're going to put a lot of effort into these. You're going to read charts. You're going to draw lines. You're going to run Fibonacci extensions. You're going to do all these things that you've spent just so many hours of your life focusing on. In the end of those 10, you're going to have probably 5 winners, 5 losers. And out of those 10, you're going to have 1 great one, 2 okay ones, 3 that are, and then the rest are going to be small losses, and there's going to be 1 or 2 that are just the worst trades you've ever made. Here's the irony. You think that every single one of those trades you're making is the big winner, or else you would have never made them. You have to understand that you have no idea which one the winner is going to be. You have no idea which one the loser is going to be. And the more you get invested in this, the harder it's going to be to let go of the losers. One of the powerful things about this experiment was how little I put into the entry. And what happens is I have so little attachment to these trades that it's very, very simple and easy to follow my system. So that was really the lesson I wanted to talk about with this PIO, is that when we put all this effort into our trading and it doesn't go our way, it's very, very difficult to let it go because of all of that effort and all that stress that you've put into the position. That is one of the things that make people hold on to losers. This experiment, it's so easy. When you pick things at random on a Ouija board or because you saw a lot of water, it's so easy to dump a trade and follow your system. Just another example to show how we are the problem in our trading. Not the markets, it's we are the problem. And it's the reason why Patrick and I put this podcast together, is to try to get people to, first of all, understand how we are the problem, then to understand, to look inside of you and say, oh, what are my issues? And then third, how to fix those issues so you don't undermine yourself. All right, let's keep going on with numbers because I got a lot of numbers to get through. All right, so we talked about our biggest gain, our biggest loss. Now let's think about this. We had a $100,000 account. At one point, it was down to like 96,000, I think was our low point. And at our high point, we ended just off of our high point. Our high point was like 116,000. So if we're doing 1% position size, that's going to be about $1,000 loss at 2x ATR. So again, that's what we said. At 2x ATR, we want $1,000 monetary loss, 1%. Our biggest loss was on EWG. It was a German ETF. I was traveling in Germany, so we did a German ETF. We were short, and we lost $1,415. Patrick, do you have any idea how we lost more than 1,000, even with the trailing stop?
Ooh, good question. I'm sure it's kind of obvious as soon as you say it, but go ahead and say it. I don't know.
Well, you deal in the world of currency so much that this was a stock. And this was not just a stock, but this was an international stock. So pretty much all of these stocks traded over in Germany, but I bought the ETF that traded in America. So basically, by the time the American market opened up, the German market was just about to close down. So whatever those stocks did in Germany would already be adjusted to what happened in the ETF in America. So there was a big up day in Germany, and then when the EWG opened up, it opened up gapping above our stop, causing us to lose more than the $1,000. One of the great things about Forex, one of the things I love about Forex, is the lack of gaps. It's really, really nice, but in the world of stock trading, gaps are an issue, and you theoretically can, and I will guarantee you, on 100 trades, you'll have at least one, if not 2 or 3, that are going to have a larger loss than that 1% that you expected.
Okay, well, that makes sense. I don't feel so bad about not knowing. Yeah, my mind wasn't in that scope, but that's really interesting too. So, well, I guess just goes to show too that on the downside, just to add on to why I think that the stats here are so spectacular, that even some of the losses could have gone past 2 times ATR, and this system still ended up doing what it was doing. So by all means, keep going.
That is exactly the takeaway, is that, look, things happen that are outside of our control in trading. There's going to be gaps. There's going to be big moves. Even in the Forex market, there's going to be big moves where your stops get slipped. That stuff happens. You can't fall apart over it because it happened. You have to trust that over 100 trades that you will be able to make up that deficit by staying consistent. The problem is, in those real world situations, when someone takes a much bigger loss than they expected to, this is where they screw up, where they either position size too large, or they try to get it back, or they get desperate and they start making trades they wouldn't have. These are those moments. So this moment right here, if this was you and you were trading and all of a sudden you expected there to be this loss and it was bigger than expected, these are the moments that challenge you as a trader, that are going to want you to bail, say, oh, I need to do something else to make sure this doesn't happen. And then we talked about this in a previous podcast about jumping systems. You can't jump systems. This is the time where people jump systems all the time and they say, oh, my system doesn't work. Trust in the system. These things will happen in trading. I guarantee you that there are going to be things that happen you didn't expect, or you take losses that are bigger than you expected to take. You need to keep swinging and stay diligent and consistent. Do not jump systems at those moments.
Well, I think that's a really good segue into your next section, if I'm reading this right, and that is when you just so happen to have your biggest win and your biggest loss of this entire 100 trade series.
We've had several episodes on dealing with slumps, dealing with streaks, what to do when you're hot, what to do when you're cold. A lot of our episodes have been based on this. I highly recommend everyone go to the Flat Earth Trading Society public journal. And if you go to that public journal, you can see all 100 trades. And Patrick, I'll give you the link that you can put in the YouTube description below, or you could go to the Flat Earth Trading Society channel on YouTube. It's on every single video there, the public link. You can go through and see how streaky it was. At one point, there was an 11 consecutive loss streak from December 29th to January 24th. This is using random methods, and it created an 11 consecutive loss streak. What do you think a normal trader would be thinking about after 11 consecutive losses?
It's a word that I'm not supposed to say on YouTube because I can get demonetized, but leaving this mortal coil maybe would be a better way to say it.
This happened. This is real trading. This will happen to you. At some point, you are going to have 11 consecutive losses. Now, in this system, again, I didn't care. I knew that it was going to, well, I didn't know, but I was confident that it was going to make money over 100 trades. I was risking my 1%. And you know what? It wasn't that big of a deal. Here's what I did. I kept swinging. But what we really learned here, there were some things to learn here. Let's think about what happened from December 29th to January 24th. Now, Patrick, we meet at the first of every single year with all of our traders, and we do this every single year because there is something in the stock market called the January effect. For 11 months out of the year, trend trading works very well, and all the numbers back it up. All the numbers back it up to where if you were to buy the top 10% of the stocks in the stock market and hold them for that month, 11 months out of the year, you would outperform the average and the lowest 10% of stocks. During those months, 11 months out of the year, they underperform the stock market average. There's 1 month out of the year where that doesn't happen. That's in January. There's huge sector rotation going on. There's portfolio rebalancing where people say, hey, my tech stocks have gotten too large a part of my portfolio. I need to sell those stocks and reinvest them into the parts that have gotten too small. Now, why did they get too small? Because they underperformed. So this right here is just a great example. we already talk to our traders about it every January, say, hey, this is likely what's going to happen. Don't get hit by it. Don't get hit by the sector rotation. Now, we couldn't do that in this example or in this experiment because remember, it's just a machine. It's random. So there's things that we can learn through all of these things. Also, during that period of time, it ended up being a more volatile period than the prior period. That is really bad for systems that have stop loss orders. Think about it. You have a system where you put in a trade, you have a stop loss. If volatility spikes, the odds that your stop is going to get hit become much higher than they were when you put that stop in place. So when you're using ATR, and let's say the ATR has gone down and down and down because volatility has gotten lower and lower and lower, when you put trades on with low ATRs and ATR goes up substantially, your odds of getting stopped out on trades jumps to maybe 50%, 70%, 80%. It wasn't because you made a bad trade. It's because we went from low volatility to high volatility. I love ATR. Patrick, I know you love ATR. It's a fantastic thing, but this is one of the negatives of using ATR is when you have a very low volatile period and you adjust your stops based on those ATRs. When volatility spikes, you're going to get losses during that period of time.
Yeah, I've always told people too that during those slower times, if you get a really big trade to come out of that low volatility, you're probably going to miss it. And you're just going to have to mentally deal with that because there really is no way to catch something that comes out of nowhere from a dead period that quickly. So this might not have been something we've ever talked about on the podcast, but I've said it on my channel before. So many interesting things too. And I'll say too, as far as January goes, I've actually had very good Januaries. I actually know that's one of my best months year after year, typically. And maybe that makes a lot of sense because maybe not so much in stocks, but if people are getting killed in stocks, maybe they just take their money out and put it into cash, and that helps us. I don't know. But for all you Forex traders out there, I sometimes I get people asking, oh, should I just skip the holidays? Should I skip December since that's historically bad? Or should I skip the summertime? I'm like, no, don't skip anything because sometimes it's bad, but sometimes it's not. And when it's not, the good can outweigh the bad over the course of the long haul. So I'm really not a fan of just taking certain days off, except for New Year's Eve. We always talk about that. And certain holidays and elections, of course. But seasonally, yeah, no, never a good idea, in my opinion. So, okay, super, 11 trades in a row. I guess when you have a 40% win rate, this is more possible. But that really is quite an anomaly, and really amazing that you still ended up as far ahead as you did, even after all that. But I want to go ahead and talk about it. This is going to be my favorite part here, I think, is the overall. You said what your worst streak was. Now, the timing of that streak and the timing of your win streak was extremely interesting. Speak to that a little bit if you don't mind.
Of all the things that happened in this experiment, this is the best part of it. This is the absolute best part of it because this encapsulates real trading so well. I talked about our worst losing streak. This 11 loss losing streak happened after our largest positive streak. So remember, the losing streak started in December 20th and went to January 24th. Well, prior to December 20th, we went on our biggest win streak. From early December to December 20th, the account jumped by $8,600 or 8.9%. So we had a good run in the first couple trades and we fell back down, and then we had this really big run into the end of the year in December. And then right after that, we had 11 losers in a row. That, again, that could have happened at any time, but boy, this is really how trading works. The streaky nature of trading, you've got to get ready for it because this is real life. Now, if you screwed up position management, one of the things I've talked about in this podcast is that I'm the most dangerous after I have a big win streak. After a big win streak, what do I want to do? Go bigger. I want to trade harder. I want to trade more. I want to do more. I would have run into an absolute buzzsaw if I got really, really excited and really started pushing my trades and then I ran right headlong into an 11 loss downtrend, that would have absolutely killed me if I deviated from my system. This is real trading. This is how you're going to feel. You're going to feel like king of the world once you have that streak. But once you've been trading long enough, you know that those are the riskiest moments.
Yeah, it's like my favorite quote from the TV show The Wire. Even if I miss, I can't miss. I have felt that way many times in my career, especially early in my career. I really thought with a whole 6 months under my belt that I just found the magic indicator combination that was going to take Wall Street by storm, and I was smart and they were stupid, and I was on the road to millions. And the moment I started thinking that is when I blew out the rest of my entire account. So just remember, especially early on, you are not the shit. You think you're the shit. You are not. Keep it consistent for Christ's sakes, because there is no holy grail in terms of algorithms. But there is a really profitable, consistent way you can do this, but it involves not getting too high or low and just staying the course no matter what.
Let me finish this little series of events, because just think in your mind, you had this huge run up in your account and then you had an 11 loss streak. Guess what happened at the end of that 11 loss streak? That was when our biggest winner of the entire experiment came. This is where, Patrick, when you say keep swinging, don't deviate, keep swinging, this is the proof. This is the proof of that, where yes, you just got hammered, you just got obliterated, your account is down, you're in the dumps, your confidence is at an all-time low. So many people stop. They jump ship, they change systems, they cut position size, they deviate. Right at that moment, that winner pretty much erased about 2/3 of that drawdown. This is how trading works. And just think about the emotional roller coaster that you would have been on during this time. Run the account up, $8 grand, $9 grand, and then lose it all across 11 trades in a row. And then all of a sudden, boom, you make back a lot of it in one trade, right when your confidence is at the bottom. I want you to just put yourself in the situation and think about what would you be going through psychologically during these streaks? And what would you be feeling? Because everything in those periods of time would be to try to get you to deviate from what you're doing. You're going to feel a lot of pressure. You're going to feel a lot of elation, a lot of depression. That little period of time that was just basically a month and a half would have killed most young traders, because right in those moments, they would have deviated.
Yeah, don't stop trading just because you're taking losses. Do not, and I say this so vehemently because what I'm telling you is to not be VP back in 2011, because that's what I would always do. I would get down. I would think the market was just going to go against me forever and ever, and I didn't want to lose my entire account. So I would just stop. And almost every single time. Well, sometimes there would be another loss and it would just justify the move I just made. But soon after, this huge run would happen that my system would have actually called, but I wasn't there for it. A trade that would have eaten up all of those losses and then some, but I wasn't there to trade it. And wouldn't you know, as soon as I got back in the market, I would take another loss. So just no matter what I did, I would lose because I really played this the wrong way. That's why I'm so vehement on this point. And we did say in that episode where we talked about this specifically, if there are things going on in your life or external factors that might be leading to this losing streak, and you're being honest with yourself on this, then okay, then you stop. Diagnose the problem, get it sorted out, and then come back. But for 99% of you, that's not the case. You're just chickening out, or you're just going soft. What you're not doing is sticking with your system. And Rob just showed you that even after 11 losses in a row, I couldn't imagine, that just because he stuck with it, that's when his biggest winning streak came. And so numbers-wise, Rob, you got it all back and then some, right?
Yes, I mean, that big gain helped, but over the next really from that low, this account really took off and just kept churning all the way until trade number 100. It's just so important. And I want to go back to just one last thing, position sizing. This is the thing that allowed, again, this experiment was just going to go on no matter what. But in real life, let me tell you what would have allowed a trader to keep going. Even though they just had 11 losses in a row, position size was 1%. The drawdown was painful over an 11 loss trade. The drawdown was 7.9% from the high to the low. It went from 106,252 down to 98,120. When you look at it that way, you're like, oh, that's not a big deal. I would be able to keep swinging. If my account just went down 7.9%, I would easily be able to keep swinging. I wouldn't feel distress. Here's the problem. When you make your position sizing too large and you get these drawdowns that now become 30, 40, 50, 60%, this is when people can't keep swinging anymore because of the psychological damage. So we have gone all the way back to the very essential thing of trading, that if you don't get this right, you can't make it. Correct position sizing allows you to go through the shit and to still have the courage to trade out of it. If you make those numbers too big, everyone quits. Everyone falters at that moment. It's so important to get position size right.
And so I just want to reiterate, too, if you want to see the details of these numbers in real time, I know it can be kind of hard to process depending on what you're doing. I know whenever I listen to podcasts, I'm usually walking or at the grocery store or something like that. So I'm not really able to process numbers the way I normally would if I'm sitting down and looking at it. So Robb has done an entire video on these numbers, and you can see them visually, and we will go ahead and link that down below in the show notes for everybody to see. And so let's go ahead and sum things up, Robb. Do you want to kind of round up what we've talked about here, or have we already pretty much spoken about it?
No, look, there's more. If you want more numbers, more details, go to that other video. But let's just talk about after this is all said and done. So I wanted this to be out there for the record, for all time, just to where everyone can go, look at it, follow it. You can actually see every 100 trade, where we made it, where we got out, when we adjusted the stop. It has a video about it. I had a whole team helping me out. So all of it's there. What I want everyone to take away from this is, number one, consistency beats intelligence every single time. I know a lot of you think you're smart. And guess what? We all think we're smart. If we didn't think we were smart, we would have never gotten into trading. We would have never had the guts. So the fact that we are into trading, we're already thinking we're smarter than everyone else. Guess what? Consistency beats intelligence every single time. If you want to be a great trader, I don't care how smart you are. It's totally meaningless for me. How consistent can you be?
Yeah, smart traders usually have it worse because they overthink things. I see it all the time. Now, you can tell when somebody responds and they're pretty intelligent and very analytical. They sit there and try to overanalyze every single thing you just said. And I have to tell these people, you need to pull it back. You need to dumb it down somehow. Don't overthink it, because that's all I ever did. Pretty much throughout high school and college, even when I would try to do well at a subject, I couldn't, because I would always try to think of exceptions. So when it came to algebra or equations that you would see in chemistry or something like that, I would completely fall apart because my mind just couldn't simplify it the way I needed to. And I've said this numerous times too, because it's an observation I find to be so funny. When you see these like champion traders, these aren't like chess prodigies. These are just your average doofus guys with their, wearing a Supreme shirt and their hat on crooked. Like they're not super geniuses. Super geniuses struggle at stuff like this because they try to overthink everything. Build a goddamn system and just let it do the work. I mean, can't you see with this video in this episode that we're putting out right now that in practice, all you have to do is just not involve yourself and really good things will happen? I mean, we've taken a money management strategy that is probably half of what most of you guys are using and have limited it pretty severely, and even it is able to crank out a 15% return in about a year in 100 trades. So if that's not evidence enough that you need to stay out of the way, no matter how smart you think you are, I'm not sure what else we can really do right now.
What you just said is the whole point. The whole point is experiment, and that's exactly what I wanted to show, is that we have no control over returns. We have no control over our trades. We all lie to ourselves in the beginning and say, well, I know it's going to bounce here, and I know it's going to go here. No, you don't. Remember our famous saying, you don't know shit. What you do know is you're going to make a bunch of trades. Some are going to work, some aren't. Some are going to be decent winners, some are going to be decent losers, some are going to be great, some are going to be awful. You have no idea which one those are. So you're going to treat them all the same. When you do that, here's the greatest thing about trading. You start with an edge. I'm pretty sure that when every single one of us got started in trading, we just focused on the entry. We just had to figure out the entry. Here's the problem is that we're starting off in the hole. We have to try to make an edge that's so great for us that it can overcome our psychological problems that we're going to mistake. If you start out with good position management that has a proven edge, you have plenty of time to develop entry systems. You might not be as profitable as you want, but you'll be a little bit profitable. That gives you a lot of time to build these systems and test out entry strategies. But like the rest of us, we all jumped into the entry. And it took us years to finally get good enough at entry and then get it good enough at psychology. Just start with good position management. And then that gives you a lot of time to figure out the rest. And the last thing I want to just add, remember this, write this down, put a sticker on your computer, whatever you need to do. Deviation is the enemy of trading. Write that down, tattoo that on your forehead. Well, actually, don't do that. Tattoo it somewhere else. Deviation is the enemy of trading.
Yeah, it's funny how it seems so simple when you say it. And you're like, oh, well, that's all I have to do, no problem. Yet we have dedicated probably over 70 of our 72 or 3 episodes that we've done so far to this very concept. And I guarantee you the majority of you are still doing it. And if you're still journaling the right way, like we tell you to on here, you can see just how often that is. So we will continue to move forward and try to get that number down. But just so you know, yes, we're not talking out of our ass over here. We're actually experienced. We've made all these mistakes before. And when you come out the other side and you do this the correct way, good things can and will happen. And now you have some proof right in front of you. So first of all, Rob, congratulations on 100 episodes. Congratulations on your results and proving a very important point that I hope a lot of people see over time. I wish you and I both had a bigger audience so the world could see this, but I'll do my best to let everybody know about it. Is there anything else you want to say before we sign off here?
I do want to thank your listeners who have supported me through this entire episode or this entire experiment. It was a lot of work. I am not sad that it's over. I'm very, very happy it's over. I have no intention of ever doing this again, but I'm very glad that we now have created the record. Just like I wanted to know about those 2 traders years ago that threw those darts, what were the numbers? How did it work? What did they do? I don't know the answer to that. From this point on, everyone can see the record is there. I'm so happy I did it, and I'm so happy it's over. And I thank every single one of you for supporting us, for your comments, for your funny comments. We've enjoyed it, getting to know a lot of you. But it's time to move on to a new project. So thank you so much, everybody.
And it's time to move on here. For Robb Reinhold and myself, thank you for joining us here at the Trading Psychology Podcast. We will both see you next week.
Goodbye, everybody.
And suck it, haters.